Mphasis, which has been slightly sluggish today in trade. Let's go across to Rahul Dayama with the management of Mphasis.
So firstly, I think I'm very happy with the overall performance. I think our core business has grown really well, both in direct core as well as HPDXE. I think our deal wins have been good consistently over the last 6-7 quarters, and that's kind of obviously reflecting in the overall revenue growth. So I think to have a high double-digit growth in direct core and over 25% growth in HPDXE really sets us up nicely for a full year growth as well. I think there is obviously some seasonal weakness still into these numbers, given this is almost always a seasonally difficult quarter. But despite that, I think we managed both revenue growth and margin. We've retained a pretty healthy margin as well the quarter. Coming to digital risk, I think confluence of factors. Firstly, the market volatility doesn't help, especially as it relates to certain project-based. We do a lot of due diligence, business on the mortgage securities. So that business just took a pretty big beating with market volatility that happened in Q4 calendar and Q3 for us. Secondly, I think the mortgage volumes are still pretty challenged given the interest rate environment in the US. So certain deal wins got pushed out. So I think that kind of played up in the DR. So that was probably the only red spot we had on a growth. Obviously it declined. We think on a sequential basis we'll find growth back into that business in Q4.
All right.
So sequentially. Of course, I don't think that industry is out of the headwinds yet. But I think from our portfolio perspective, sequentially, if you see growth in DR, that becomes another growth vector, at least for a QOQ basis.
All right. Surya, on the margins front, decline of 60 basis points, 16.8. What was the impact of the staggered wage hike? I know you're retaining your overall margin guidance for this year, but how do you see the margin trajectory also at a time when we have also seen larger IT peers raise of concerns about subcontracting costs getting higher? The rupee has also sort of settled to the levels that we saw over the last quarter or so.
So I think let me first come to our FX movement with respect. And as you are aware that we have a very consistent hedging policy. So we are quite insulated to any dollar rupee movement. With respect to the margin, I think we had advocated right at the beginning of the year of a 15 to 17 EBIT band. And we are quite confident the way it's panned out till now, Q3, that full year we'll be well within that band. And we are confident with the operational efficiency we have brought into the system, we will achieve the numbers.
Got it.
I think there is one other item that obviously wasn't budgeted for when we started the quarter or the year, which is the acquisition costs.
Yeah.
Now, obviously, given the new regulations, we can't amortize those. So there's full impact of the acquisition cost in the quarter. There's obviously the headwind from wage hike, the seasonal slowdown, client shutdowns, as well as the digital risk impact. So I think despite that, if we maintained EBIT at 15.8, I think that augurs well for us.
But Nitin, also Jan is the time when you sort of see, IT spends. How's the commentary like? There are already murmurs about macroeconomic uncertainty, vis-a-vis US Brexit also. We don't know which way it will really go. Do you see, FY20 to be softer compared to this financial year from a demand perspective especially?
I think it's too early to call out FY20. We'll probably have a better idea over the next couple of months. And when we do our fourth quarter call, we'll give you more color. But in terms of client impact, of course, there are segments of the market that have called for a slowdown. But we are not seeing any of that, at least in the current commentary from clients yet. Thing to note, though, is, in our business, there is also good upside opportunity when clients are looking to take cost out. Only thing is you have to have the right set of service offerings to do that. So I think we are confident that we have a pretty good complement of services, both for digital transformation, core application transformation, and cost takeout.
We'll have to wait for at least another quarter to see how the demand pans out. On the acquisition front, you announced an acquisition, Surya, this quarter. How do you see that adding to the revenues, to the margins as you go ahead? It's been, would we see the full effect starting Q4 and then sort of playing out as we move?
Yes. So I think the acquisition had two-pronged approach. One, the revenues from the asset as it is, which we had already called out, it will be less than 1% of our total revenues. But more importantly, with the expertise which has been capabilities which are coming as part of the acquisition, that will drive growth in other clients with that particular capabilities. So we are confident that is actually a driver for our direct channel growth.
Got it. Nitin, lastly, analysts have penciled in a 12 to 13% dollar revenue growth for this year, which you would, by our fair estimates, really tide through. So will FI, the next financial year, also see that growth momentum continue? Somewhere I'm trying to get a sense of where is all of this leading to?
I think, again, go back to what I initially said. We called for sustained, consistent growth. That was our number one priority.
That effort's paying off.
Yeah, that we started in FY18. I think FY18 we grew about 11% in constant currency. This year we are on track for mid-double-digit growth in constant currency.
All right, that